Well, hello, Facebook and YouTube. I'm Brantley Whitley, and the guy sitting next to me that I'm not going to try to point at because I'll point in the wrong direction is Brandon Roberts. We're from the insuranceproblog.com. And, this is, I don't know, our 11th live broadcast. And today we're going to talk about, I guess this is sort of part two of what we talked about yesterday, or continuation of the discussion we had yesterday, where we talked about the cash value accumulation test, or CVAT for short, and the guideline premium test, the GPT for short. Yesterday, we focused more on how those two premium tests work with whole life insurance. Today, we're going to talk about it in the context of universal life insurance, which may or may not be of interest to anyone. I'm not really sure. That seems to be in the cash value life insurance world, that's very much a house divided. And we're not going to get into that division today, but we are going to talk about premium accumulation tests stack up with universal life insurance. So Brandon, tell us all about it.
Sadly, I think we have the same problem as yesterday, where no one knows what we're talking about because you had a little bit of a blip there. So today's discussion is
if someone works for Cox Communications would like to fix my internet once and for all, that'd be fabulous. It'd be really great to actually get the speeds that I pay for. But anyway, I digress.
So today we're going to talk about how one can effectively make a universal life insurance policy reduce paid up.
Okay.
So we did have a discussion a couple of days ago or a week ago or so about the reduce paid up feature on whole life insurance.
Yes.
And we were very specific to talk about that in the light of only whole life insurance, because it is certainly I don't want to confuse this issue. That is a non-forfeiture benefit afforded to whole life insurance and only whole life insurance policy.
Right.
Universal life insurance policies do not have, for the most part, a reduced paid up feature. There are a very, very limited number of circumstances where some companies have rolled out a pseudo paid up feature on a universal life insurance policy, but it does not work the same way reduced paid up does. So I don't want to confuse those two things. I want to be clear in stating that for universal life insurance policies, there is no reduced paid up option. In fact, for universal life insurance policies, there's only one non-forfeiture benefit, and that is to surrender the policy for its cash value.
Right.
That's it. Right. So that being said, for somebody who's looking at universal life insurance and wondering if there is a way to at least kind of mimic what whole life insurance can do, do we have any options? And the answer is yes, actually, because universal life insurance is extraordinarily flexible. That's kind of its key known feature.
Right.
And that flexibility affords several things related to design and functionality after issue that allows us to do a lot of the things that insurance companies do with whole life insurance, and will permit us to do something that is similar to, though certainly not identical to, the reduced paid up option on whole life insurance.
Right. It doesn't have the same guarantees attached to it.
Exactly. So keep in mind that a reduced paid up trigger on a whole life insurance policy means that the insurance company is looking at the current cash value of the policy, and they're going to derive a death benefit that they can reduce the current death benefit to, that is supported by the current cash value in the policy. That's all they're doing, by and large. Now, the other thing that the insurance company is obligating itself to is stamping a guarantee on that to keep the policy in force for the rest of the policy period. But functionally, what the insurer is doing is taking the cash value that's in there currently and saying, all right, what level of death benefit is supported by this cash value forever and always?
Right.
We can do that with universal life insurance. You and I can do that with universal life insurance. We can take a current universal life insurance policy, we can look at the cash value that's in it, and we can determine what level of death benefit would be supported with that cash value for the rest of the policy period, given either current assumptions of the universal life insurance policy or the guaranteed features of the universal life insurance product.
Right.
We don't have the same ironclad guarantee in place that a whole life insurance policy would create, but we have reduced the risk of failure to a point where it's extremely unlikely.
Right. Did I freeze again?
No,
Now I'm paranoid.
I think you're still good. I think, though, that the only thing people can see is me, but that's okay.
Yeah, that's fine.
So that functionality with universal life insurance affords us the opportunity to basically create something that would work very similarly to a reduced paid up whole life insurance policy. We're going to minimize the expenses of the universal life insurance policy by reducing death benefit. That will absolutely shrink the cost of insurance. And it will most likely eliminate any need for future premium payments by the insured. We should also understand, though, that while this option or this triggering event on universal life insurance will not create the same result as reduced paid up, in the sense that it's with reduced paid up insurance, we cannot put any future premium payments in there. The dropping of the death benefit for universal life insurance doesn't necessarily stop us from making premium payments, but it would most likely prevent us from doing that due to the qualifying test, either the guideline premium test or the cash value accumulation test, applicable to the insurance contract.
Okay. So what would be the advantage of I guess I'm sort of dovetailing off the, and I'm going off script here. So on the discussion that we had yesterday, what would be the advantage of using a UL policy, or would there be any? I'm not trying to allude that there is. What would be the advantage of using a UL policy in this way to effectively create, your own reduced paid up policy, though it's not technically reduced paid up, versus a whole life policy? Is there any advantage?
So in a case where you are trying to keep a death benefit in place, and you do not want to or cannot make future premium payments, this would certainly be a way to preserve at least some level of death benefit without most likely requiring future premium payments. Additionally, or alternatively to that, as another application, would be somebody who has accumulated cash value for the purpose of income production, taking loans from the policy, for example, for supplemental retirement income. In that circumstance, they may find that reducing the death benefit further maximizes the value that they can create with the policy. It eliminates some future expense, and it allows the policy to distribute more money income-wise than it otherwise would have. They can either choose to take that money out or give themselves a greater degree of assurance that the level of income that they are bringing from the policy won't lapse the policy in later years.
Okay. Now there was some stuff in the notes. I'll try to get us back on track here so that you can. There was something that you also wanted to mention, I believe, in regards to 7702 testing. And
the most important thing to understand, just as we talked about yesterday, universal life insurance's flexibility subjects it to a number of possible pitfalls with 7702 testing, guideline premium test or cash value accumulation test. And so if we trigger a reduced paid up option on a whole life insurance policy, we might have a problem with the modified endowment contract test, but we never have issues with the 7702 testing. With universal life insurance, we could absolutely run into a circumstance where we have a problem with the 7702 test, because the reduction might seem okay today, but might not be in the future. And it might create a force out of cash, for example. So in order to remain compliant with the 7702 test, we have to withdraw money out of the policy to keep it from failing the test. That does happen in some circumstances. The flexibility of universal life insurance does set the stage for the possibility that we make a reduction that's a little too deep. We reduce the death benefit too much and discover sometime down the road that by virtue of having done that, money has to come out. That's never on the table with whole life insurance, but it could be a circumstance for universal life insurance.
When you say money has to come out, you mean money actually has to be forced out,
withdrawn. Yes, it has to be withdrawn from the policy.
Right.
This is not something that I think we should probably put a little bit of a disclaimer on this one. This is absolutely a usable and very handy feature if you understand life insurance, specifically universal life insurance. But this is not something that the novice or the lay person necessarily wants to undertake alone.
Right.
I bring this to you as additional information to further everybody's ability to understand what these products are and what they can do for people. But this is probably not something that we DIY.
I would say definitely not. Yeah.
It's a little more complicated and requires a little more just in-depth knowledge, potentially institutional knowledge, just a little more understanding and expertise on this area. But understand that it is possible. That's the important element of today. That universal life insurance is not fighting. It's not in a fist fight with one hand tied behind its back versus whole life insurance because it doesn't have the non-forfeiture benefit to trigger reduce paid up. It has functionality available to it to make it very competitive against that product. But there are absolutely some caveats. Whole life insurance is much more autopilot-like, whereas universal life insurance requires a little more manual processing. Whole life insurance is the automatic transmission. Universal life insurance is the form of transmission that needs to die. Universal life insurance doesn't need to die, by the way. It's just
bad comparison there.
There's an inside joke between me and the missus on that one.
Well, I mean, the thing about that I'll also add that's a little probably is very high level and simple when it comes to using your universal life insurance in this way as well. That makes it very not DIY friendly is that it very much depends on what company you're dealing with as to whether I would even want to attempt this. Do you agree with that, Brandon? I think you know where I'm going with that, but
I know exactly what you mean by that. So some companies are a little more user-friendly to service.
Just because it's possible doesn't mean that you necessarily want to attempt it with the contract and company that you currently have.
Yeah.
Because as we have learned through much pain, suffering, and gnashing of teeth, there are some companies that excel at policy management, and then there are pretty much all the other ones that don't. So sometimes just because something can be done doesn't mean that you want to get on the phone with someone in customer service and try to have them help you execute this.
Right.
Because they may not understand what you're talking about.
That is correct.
So, all right. Anything else?
I think that's it for today.
All right. Well, thanks so much for joining us again. And if you have a moment and you care to check us out, you can head over to ipblive.com and read more about our book, Predictable Profits. As always, feel free to visit us at theinsuranceproblog.com. We do publish new content regularly, and we will be back with you next week.